Supermicro is entering a very different phase of its growth cycle, and the market response is beginning to reflect that shift. If you have been following Nvidia's stock trajectory or the recent moves in Apple, it is clear that the hardware layer of the artificial intelligence buildout is transitioning from an early expansion phase into a more competitive, margin-sensitive environment. For Supermicro, the central question is no longer simply whether the company can continue selling more servers. It is whether it can preserve profitability in the face of aggressive pricing pressure and rising costs across the supply chain. This concern intensified after the company's late 2025 revenue report, where Supermicro delivered approximately $5 billion in revenue, well below market expectations. While management has since raised fiscal 2026 revenue guidance to at least $36 billion, the market has remained focused on the uncertainty surrounding execution and margin sustainability. Growth remains the baseline expectation, but the cost of maintaining that growth has increased materially. Today's roughly 2.45% to 5% gain represents a relief rally rather than a confirmed trend shift, and that move is occurring into technical resistance as the month comes to a close. From a market structure perspective, the stock has become a favored vehicle among self-directed investors due to its high beta and sharp intraday moves, particularly on platforms such as SoFi and Robinhood. However, that same volatility is precisely why institutional investors remain cautious. Early session volume of approximately 3 to 4 million shares reflects healthy participation, but it falls short of the type of explosive activity associated with a sustained short squeeze, especially following the 11% jump recorded last week. A widely held view is that Supermicro is a direct beneficiary of Nvidia's Blackwell chip cycle, and therefore positioned as a structural winner. The counterpoint is that Nvidia's growing dominance also increases its pricing and allocation leverage over downstream partners. Supermicro is effectively competing in a margin-constrained environment to maintain priority access to GPUs while simultaneously defending market share against engineering and pricing pressure from competitors such as Dell and HPE. At the same time, the company must continue demonstrating to regulators that its financial controls and reporting practices remain sound. Institutional ownership data reflects this tension. Firms such as Vanguard and BlackRock modestly increased their positions toward the end of last year, which appears to be contributing to price support in the $25 to $28 range. In contrast, Morgan Stanley reduced its stake by double-digit percentages over the same period. This divergence has produced a persistent tug-of-war that is visible in the stock's day-to-day price action. Options data from platforms such as Interactive Brokers currently shows a put-call ratio that favors bullish positioning, but broader positioning suggests expectations for elevated volatility through February. This backdrop exists within a broader macro environment where interest rates are stabilizing, yet capital expenditures from data center operators are coming under increasing scrutiny. The market is no longer rewarding growth at any cost, particularly in hardware segments where pricing power is structurally limited. That macro shift is directly influencing how investors are evaluating Supermicro's operating performance and forward guidance. From a business standpoint, Supermicro remains a total IT solutions provider rather than a commodity server assembler. The company specializes in high-performance server architectures optimized for artificial intelligence workloads, cloud infrastructure, and 5G edge computing. Its modular building block architecture has historically allowed it to customize server racks faster than most competitors, which provided a significant advantage during the initial acceleration phase of the AI buildout. However, as the industry matures, speed to market is becoming less decisive than cost efficiency and scale execution. This shift is visible in recent margin trends. Supermicro's non-GAAP gross margins have declined into the 9% to 10% range, well below the mid-teens levels investors had previously come to expect. That margin compression represents the fundamental tension now confronting the stock. Expectations of sustained AI-driven revenue expansion are colliding with the reality of structurally thinner profitability in large-scale hardware manufacturing. Looking ahead, fiscal 2026 guidance remains ambitious, with management targeting at least $36 billion in revenue. If achieved, the current share price of approximately $31.97 would appear materially undervalued relative to forward revenue expectations. However, another revenue miss or the emergence of additional internal audit or regulatory issues would meaningfully undermine that thesis and could pressure the downside support range. Retail participation appears elevated today, likely driven by buy-the-dip sentiment circulating on social media. Nevertheless, institutional positioning remains the more important signal. Those flows will ultimately determine whether Supermicro reestablishes its prior leadership narrative or becomes a case study in the challenges of scaling rapidly in a margin-constrained hardware market. For investors using Fidelity brokerage or wealth management services, the stock is often excluded from more conservative intelligent portfolio models due to its risk profile, positioning it more as a tactical or self-directed investment than a long-term core holding. From a balance sheet perspective, the company remains well capitalized. The quick ratio of 2.95 and current ratio of 5.39 indicate strong short-term liquidity, supported by more than $4 billion in cash. This significantly reduces near-term solvency risk and provides operational flexibility, a point frequently overlooked in bearish narratives. The issue is not access to capital, but rather execution discipline in an increasingly competitive environment. Technically, attention remains focused on the $33 resistance level, which has capped multiple rallies this month. A decisive break above that level on high volume would suggest the market is beginning to price in a fiscal 2026 recovery scenario. Conversely, a move back toward $30 would indicate that the current advance was likely a temporary reaction rather than a sustained reversal. Expectations had centered on a rapid V-shaped recovery following last year's dislocation, but the emerging pattern is closer to a jagged, grinding U-shaped process. In conclusion, Supermicro is navigating a structural transition from high-growth disruptor to high-volume infrastructure provider. That transition typically compresses valuation multiples and introduces earnings volatility, as investors reassess whether the business should be valued more like a software-enabled AI platform or a traditional hardware manufacturer. At present, the market is assigning the latter framework, while management continues to argue for the former. The stock price of $31.97, the institutional positioning divergence, and the aggressive $36 billion fiscal 2026 revenue target collectively reflect this unresolved tension. The gap between the anticipated AI-driven revenue expansion and the reality of thin margins represents both the opportunity and the risk. For investors managing positions through platforms such as SoFi or Robinhood, discipline remains critical. Short-term moves of 2% to 3% should not obscure the fact that the next decisive catalyst is the February earnings report. That event will ultimately determine whether the company's growth